guys, March the 17th, another crazy day in the markets, and it's going to continue to be this way because the world just wants to be extra volatile right now for good reason. Past performance is not indicative of future results. David always reminds me that I need to remember to say that. And so I'm going to start sharing my screen now. And we can see that we're at this particular moment having a nice green day in the marketplace with a lot of stuff up, and even crude has made its way back over 100. And it's a really interesting time. You can kind of see that you've got a mix of things. It's really, in my opinion, just trading around because there isn't, for the rest of the week, we are kind of in this bizarre quiet time in the markets. There are going to be investor days that happen, but there's not a tremendous amount of news flow. Dollar General came out, and I had been bearish, and then I think I might have mentioned very briefly to just hedge out the weakness when it dropped below 200 by just covering that up and maybe even taking a bet on the other side. But the stock has traded sideways, and it traded up a bit, then it traded down a bit. It really looks cosmetically like they did better than expected, but in fact, their same store comp was down too. Gross margins were down. Operating margins were down, obviously, because of the oil cost. And they bought back shares. So that's actually how they ended up with earnings that looked good. It wasn't because the earnings were actually of a high quality of any sort. They're arguing right now up 2%. They're arguing that their customer, which is primarily female-based, oddly enough, because they always refer to her as a her, is very sensitive to the incremental dollar, and that rising oil prices helps them because they will go to a local, wherever it is that's physically located closer to them versus farther away. I argue that that flies in the face of retail, period, with all due respect, because we are seeing Costco just have larger basket purchases. They are seeing larger basket purchases. So it's really like when people go to Dollar General in this type of market, it's because they were out of just something really small and they don't have their next paycheck yet, which is their primary customer. And so they'll go to the Dollar General. But even though the economy is strong, I kind of want to go through some of the numbers so you can kind of make your own bet on whether or not Dollar General is a short, for lack of a better way to describe it. I think that for no matter what you decide to do, you should try to allow it to settle a bit. But I just want to follow up on that one briefly. I'm not going to say too much more about that right this minute. But we did have the FOMC meeting come out, and we had the Fed chairman speak. The Fed announcement on the Fed funds rate. So we got 25 basis points. I know David was hoping for 50, but I really do feel that would have shocked the markets aggressively, but we don't even have to think about that, which is nice. We just have to worry about the next Fed announcement. I want to go through three key things that were discussed because they're really important, and I'm not sure how they're being discussed in the marketplace. My suspicion is everybody is just trying to digest them, but I really want to show you the full graphs that he went over in the conference thereafter. They are published. I will put them in the Discord so you can see them yourself. But sometimes with graphs like this, if you're not used to already seeing and interpreting them, it might be nice to just have someone walk through it with you. With the GDP growth estimates, you can kind of see, I should have swapped these, that GDP is still, for the year, they're looking at 6% originally, but now there's this feeling that GDP growth is going to be 2%. And he mentioned it's probably not 6, it's probably 2. Quite frankly, on the estimates, it just came this is us right here now at 2. And he talked about that a bit in the discussion afterwards with all of the folks. And he was saying, 2% is actually quite high for the United States. That's true. That's actually very true. 6% was crazy high for the United States. That's really back to 99 levels when you had the millennium transformation and people buying, concerned about how that would play out. 2% is pretty decent, but I kind of want you to see the shape of this 2%. Like this is actually quite wide because we've got anything from negative, we've got slightly below 0% in 2024 with some massive slowdown right? So there are some people that are really worried that this might be the last year of growth, and how the equity markets might price that in is not an insignificant thing. But this dispersion is not great as far as that goes. And so when I talk about, hey, vol should be amplified in the current market environment, I'm not kidding. It really should. These are really smart people that all don't agree. And they also have a say on what happens, in the sense that they inform our wonderful Fed chairman. Hopefully he gets appointed and reelected. We don't go into another series of volatile craziness because of that being a concern. Okay, so just realize that most folks, the uncertainty currently does seem to bias ever so slightly higher, but broadly similar. So, and then risks to GDP growth, this swapped from being balanced to like, no, we're really actually concerned that the revision or any kind of downward estimates going forward are going to be weighted to the downside. This is not good for a volatility perspective. Unless you're long vol, then it's great, but it does increase volatility in this particular scenario. Sometimes it's not the case, but most of the time this particular scenario bodes poorly for the equity markets, or just means that the potentiality of corrections can be larger than normal. Let me say it that way. Unemployment is actually looking great so far. The unemployment numbers have come down dramatically from pandemic times, as you can see, and most folks are thinking that it's well under 4%. But I want you to understand this cone of unemployment. This is bad, actually. This means that people really don't agree on the state of employment going forward, and in this case, it's going to be because of inflation, which I'll talk about next. And you can see that the uncertainty of unemployment is largely speaking biased towards higher unemployment. So the Fed is very worried that the unemployment risk is weighted towards the upside, and we go back into this period of stagflation, or we go into potentially stagflation with inflation, but also not enough jobs to help consumers be able to absorb the inflationary effects. That's what these little dotted lines tell you. They tell you that before everybody was like, yeah, it's more or less going to settle here. Now they're weighted towards, no, I'm actually kind of worried that all of these jobs that are listed go away, because we start to be concerned about how aggressively we increase interest rates and what that might do to demand domestically, but also to the extent that businesses do also have global components of what they're doing, global demand. And then last but not least, and very important, inflation. Typically CPI is the major number, but PCE is what the Fed uses to think about inflation. So when you see inflation quoted on the news, they're always referring to CPI, but when the Fed looks at it, they use this PCI inflation number. The reason they do that has to do with the mix of basket. That's a longer story. We're not going to go through it on this call, but I want you to understand that when they look at them, estimates are looking very high, as they are, because we can see them in the CPI, and there's very little difference between PCE and CPI as far as the trend of what we're seeing and the approximate value that they're showing. But you can kind of see that the inflation expectations are just really, really high, and anyone that was balanced actually shifted into weighted to the upside for this quarter. So it's not great. Now, I want you to really notice that right now they're thinking that these things will correct themselves by 2023. You can see inflation dropping off precipitously. Not everyone feels that way, and not everyone feels that we've stopped or stabilized any inflation in current times. And I tend to agree, because we do know, and we have talked about extensively, almost to a point where some of you probably are like, she's a broken record, that food and energy and semiconductors will take some time to resolve. They're not going anywhere, and they cannot be stopped by raising interest rates. Raising interest rates can only decrease demand in things where you have some sort of flexibility to change that, but you're not going to stop feeding your kids, and you're not going to stop going to work if your boss forces you to. Fiscal policy can change that, and a number of other just corporate policies can change that, but the Fed in and of itself cannot change the price of gas and oil. The price of oil and gas is really set by global demand, and that is what it is. But I want to really start talking to you guys about the relationship between food and energy, and as a result, something that almost pains me to be bullish on, and that is coal. I mean, look, I'm not, someone who is insensitive to the fact that we got to get better at fossil fuel usage globally, and particularly in the United States, which is the largest user user of fossil fuels. We've got a lot of habits in the United States that actually exacerbate that versus help that. Not the least of which is that the United States has a lot of people that have McMansions out there that they're trying to keep cool exactly in the areas where you would most likely need to use a lot of heat and energy. But I want you to really understand that I really think, energy today is trading back up over 100. That makes sense to me. I want to remind you as well that WTI does actually cease. For some reason, it's not letting me switch screens very easily. WTI does actually expire on March the 22nd, so I anticipate for the next few days very odd trading of oil and gas. Since these ETFs and all the other market indicators that people use are all linked to, the commodities market, you may see very strange oil and gas pricing as the March contract as people roll that contract forward. But nonetheless, the idea that suddenly a bunch of sanctions changed the amount of supply of oil and gas on the immediately, it really is not Amazon Prime where you can just order up a bunch of oil and gas. Someone actually has to pull that out of the ground. Do you know what I mean? And then somebody has to do it for the long term. And that is not, it should, like, the volatility in that market is a function of the fact that capital spending has been weak. And I'm going to show you a few slides associated with that and why, unfortunately, I have to be slightly bullish some of the coal stocks right now and bullish that for a little bit of time. First thing I want to show you is this slide. It came from this wonderful group of people, Ag Manager. I'm actually going to link their videos in my from my YouTube to their YouTube. There was a Kansas State. If you think about it, wheat, actually, KC wheat is one of the ways that the local farmer would price their wheat. The Corn Belt, et cetera, closer to the Midwest even than Chicago is. But Kansas State puts out amazing agricultural research. Now, no one's perfect and no one can see the entirety of the global supply and demand, but they had a big conference online and they made all the videos available. And I think that's wonderful. I mostly agree with everything that was said. There's a few things on the global front where I might have very minor divergences or very minor little additions. And that probably is with some of the stuff that wouldn't necessarily touch the arguments they're making. But this was a beautiful slide that one of their economists put up, and it talked about fertilizer and the price and what we've seen. And what he said about this, and again, I will link this to the Discord so you can see for yourself how he verbalizes it, is that he was anticipating that the price of nitrogen, the green line here, would do approximately what it did in the past. Here is the spike up. This actually was the other time. I used to own Mosaic back here in 2008 off of the potential spike that was happening in that period. That's how I knew to kind of start going back to it. But here he was thinking that it would just do what it did here as the price of oil has shifted over the years. I think where they might not totally be on the same page with me, but not necessarily on a different page per se, it's just since oil and gas is probably where I'm a little stronger even than in the ag complex, which has a lot of extra nuance with rain. Is that I believe that it's Biden's policy that's doing this, and other people believe it's something else, and that's cool. But nonetheless, nitrogen is always separated from potash and phosphate for various reasons in the NPK, because nitrogen is much more closely linked to energy. And it's closely linked to energy. We talked about last time the way that corn absolutely is linked to the ethanol price, which absolutely links back to the price of fuel, and will absolutely mean that companies like Archer Daniel Midland will consider, instead of using that corn for food stock or feedstock, translating it into ethanol and selling it that way, because the margins are sweet and wonderful as long as this oil price stays as high as it is. Okay. Big long sentence, of course, but nitrogen also it comes off of the gasification of it comes off of natural gas, and there's two ways to get that. You can either get it off of nat gas or you can get it off of coal. And right now, so one of the bigger coal companies to look at would be ticker CEIX. Let me pull it up here for you guys. Sorry. I was looking at some charts right before just to see how these guys are correcting and doing their thing. But this coal company is one of the larger producers of coal. They are based Well, I mean, I think some Pennsylvania, and then they ship out and have a bunch of facilities in I think the West Virginia area, but really it's East Coast coal that we're talking about. Come on now, internet. I don't know why. I think it's like when I add Zoom to all my other trading stuff, it goes a little bit haywire. Sorry, guys. Anyway, we'll come back to that, give that a time to do its thing. Sorry about that, guys. But this comes from, maybe I can get it off of one of the slides that I pulled from them. All right, maybe not. Anyway, it like they have actually done a lot to improve their business significantly. The EBITDA margins on this are super high at this point for what it's trading at. Here we go. If y'all can see my screen, Console Energy, ticker CEIX, up significantly today, but I think it's going to continue to do well. I would accumulate a position slowly on this because the market's so darn volatile, but these really are its statistics approximately. I'll get you a better confirm on this because sometimes you got to adjust for some things, but this thing is trading at 4 times earnings, 5 times EBITDA. All they did was pay back debt this quarter. That's why these numbers are so crazy good. And it had been that the story in coal was to, since we were moving off of it, that they would start continuing to improve their facilities and abilities to ship that right on out to other countries. But now, because of what's happening on the global markets, it's probably the case that there's a lot of domestic use for coal. And we definitely, as we have talked about more than once, have used coal to get us through this really cold winter that we experienced on the Northeast. Now, we're just in March right now. We're in spring. It's still possible that you can get another spike in winter. If that happens, all bets are off. These things should really run aggressively. But if it doesn't happen, then you do have some time to figure it out for this before we get to the summer months. And that is also, by the way, enough time for some production to come on in nat gas and oil, but it's not enough for a lot of production to come on such that we'd be able to solve some of this inflation that's happening. Additionally, you got to realize that this fertilizer price is a real thing. You can actually make nitrogen from coal. It's just really, really a dirty, ugly process. But unfortunately, the wonderful Biden policy, which I know is very controversial, has put us in this spot. This is a slide that comes from their deck from the quarter, and you can listen to them talk about their business. They are a public company. Just you can listen to their earnings report. Oops, sorry about that. Little blatant advertisement for my YouTube. We finally got the URL Markets with May on YouTube, so definitely check that out. But you can see what they were thinking LNG capacity would be and growth would be, and it's not good. As you can see in 2022, they were really anticipating this, and they reported, by the way, before the conflicts got escalated there. You can see that the capacity for LNG supply growth was going to decline, not increase, and that's a function of the commodity curve, which we've talked about in more than one episode, so I won't beleaguer that here. And then I want you to understand that I'm not really thrilled by this, even though a lot of technologies have improved. So I wouldn't necessarily take this as the actual number. Okay, because this slide comes from 2008, so I'm not going to lie. There's been significant improvement in CO2 emissions as relates to both of these forms of energy, but you can kind of see just from a relative perspective, it's about half as, natural gas is about half as emitting as coal if you're trying to understand, like, well, if we could just switch the world from from coal to nat gas, would that help the environment? The answer is yes, it would. Now, this is gasification of coal. So this is how you might be able to get a little bit of a improvement in the fertilizer. And as you can see, that's ugly. But you know what's uglier is starving children. That's what's ugly. So unfortunately, you can see that if we don't get a hold on this, given that Russia, Belarus are big producers of nitrogen, Canada is another place that does produce it. We produce it a bit, but if we don't get a hold of this, unfortunately, the environmentalists will have the exact opposite reaction of what it was because they really just didn't appreciate potential alternatives to a coming off of it so aggressively situation. And also, they were a little antagonistic to nuclear. And nuclear would also solve this problem. But unfortunately, most countries did the reverse. They got rid of their nuclear and went to nat gas and attempted to pile in a bunch of CapEx into things like wind and solar, which are incredibly energy intensive to create. So that's the state of affairs as it is right now. As a result, you may want to take a little bit of exposure to this company, Consol Energy, on the near term, because they probably got at least 2 good quarters of just crushing it. And, what I'd really love to see is more technology continuing in this area of how do you make coal less polluting as a possible solution, because otherwise, I don't know how you really, how these sanctions create any meaningful impact on trying to get Russia to calm down over there, for lack of a better way to describe it. So that's that. The final thing that David texted me that he'd just like for me to go over is the purchase of the MGM. Now, look, MGM was known in the stock, so I'm actually, look, when these announcements, when deal closes, everybody gets really excited and they bid the stock up. I told you that, if you were going to do credit spreads, you got to stay behind 3,200, and then you should be a little bit farther back in your puts. We had covered the puts, as you know, at 2,700 when Amazon came in. But I want you to just understand what is that business exactly. And it's not broken out, by the way, in the numbers. So maybe some of the analysts on the street that do an even deeper modeling technique. I don't model, okay? I just read the releases and then listen to what they're telling me is going to happen. But here's product sales, right? Product sales are flat. That's most of their business. And then this service revenue is split on the quarter. About 10% of it, by the way, is put 10% of revenues. I'm sorry, 10% of this down here. Actually, I don't need to guess. I have it on the next slide. So it's about 17.7 of this number here, right? So that, what do you call that, a third, I guess, maybe a little bit less than a third, 25% of the service business is Amazon Web Services. Okay, cool, right? This thing grew 21%. Amazon Web Services grew much faster than that, 48%. And so instead of doing the math, you can just look at this slide. If you added back in that, so products was flat, right? So the 9% growth, that's where the other businesses sit. And there's a bunch of things in there. There's books, and then there's also Amazon's business, their movie business. But remember, most people get the movie business as an addition to the Amazon Prime. So all of that increase of 30 basis points or 30%. Was going into this massive, ridiculous fuel increase. Let's see what they got: cost of sales, fulfillment. Fulfillment is the cost of fuel plus the cost of headcount on the quarter, which was up a whole lot, as you can see. So what does that mean? That means that I'm not quite sure how MGM is going to, even with all of that wonderful content, is going to truly do much to move the needle here, right? It's just, services is a big part of the business, even if you take out the web services piece. But there's no plan that's been announced for how they're going to sell more movies through. There's no plan. There's no, will you have great programming? Yes. Is that the reason most people are buying Prime services? Probably not. So then it just becomes like, am I going to, an inflationary environment, allow my kids to just buy whatever it is it's on MGM that's kind of stale media, if you will, for a price that's going to actually drive revenue growth and profitability? I don't know. I think that's aggressive. I think what you have to do is actually fix this core business. So that's kind of where I fall out on that. I'll go ahead and stop this portion and take questions now.
Well, hey, May, thank you. This is Dave.
Hey, David.
Will the fuel cost just increase for the first quarter?
For Amazon, yeah. The fuel cost fuel cost absolutely increases, and then you get some of the benefit of the raise in Amazon Prime prices, and it's whether or not those cancel each other out in a way that's worthwhile. I think they actually cancel each other out so that you still have to fix the core business. I don't think that you get such amazing pop and benefit that you fixed it. And I think that's actually what was said on the call in some ways, to be fair. Maybe there's a different way that people interpret it, but it sounded to me like he knew he was still going to struggle through this next quarter. Now, for me, because it's a really crazy world, and it's really crazy sometimes where the estimates go on things like Amazon. So I probably will not try to play Amazon all the way into earnings. I'll probably let the market momentum folks do what they want to do. But we aren't, like, they won't report again until towards the end of April, maybe May 1st usually, or something like that. So you've got a good 2 months of we have no idea how to think about this going. And then in that time, you have food inflation, which will hurt gross margins. And because remember, they still have the Whole Foods business. And then
Right,
you've got freight and shipping costs that are happening. So it's not that straightforward, in my opinion.
right. And the fourth quarter, that should have been their biggest quarter, right?
Yes,
Because of
that's my
Christmas.
beef.
Okay.
I was willing to
Okay.
accept everything that happened from the third quarter, and even in the third quarter, which wasn't great, by the way, it wasn't. I was willing to be cool with it because everything he said he was doing made sense to me as related to the fourth quarter. I was expecting, he was like, we don't want the sellers to feel like they're going to lose a lot of money by posting on Amazon. We want them to continue, so we'll absorb some of that cost. Plus, there's some other things that are happening where we're absorbing the cost and so on and so forth. Plus, we want to make sure we had enough inventory. So that's what's happening in the third quarter in theory. In practice, I should have seen margin expansion in the fourth quarter. I did not. I saw the opposite of margin expansion. So that's why I'm not thrilled with Amazon right this minute. And I think that it should continue to be volatile, but I think anyone trying to bid it over 3,200 or even at 3,100, it keeps peeking its little head, is aggressive. This stock is not cheap. It trades at 50 times. At $30,000, you're trading at almost twice the multiple of Google. And you got things to fix.
Right.
Google does not have to fix stuff. Google's doing just fine,
Yeah, that leads me to my next question. As interest rates rise, how does that multiple affect the overall multiple of the market?
You know what? It's really weird. I've heard all kinds of discussions on this, and nearest I can say is I'm not convinced so much, right? Because some people will say, oh, well, it actually affects the discount rate, and so therefore you should discount the future earnings a certain way. I've never been a really big fan of that because, you know, um, the reason that's being done it presumes a certain behavior of the risk-free rate of return that hasn't existed since the Volcker period, since just after the Volcker period, right? Something that moves around that aggressively is really hard to think about as a risk-free rate of return or some kind of discount. So in general, I had for many years, even in my old role, been really annoyed at the risk-free rate of return, especially, I mean, remember when you're subtracting it on a quarterly basis, you got to take the 3-month rate. You know what I mean? And then,
Right.
discount all the way back your cash flows. Even as far back as 30 years, you're only taking 2.5% out. And that's presuming that you don't have any kind of volatility in that rate, or maybe you're doing something else that I just don't understand. I'll give it to you. That's fine. But it doesn't act like a risk free. I don't know. People will tell me I'm just an idiot when it comes to that, and I get it. It's fine. But like, I'm not a huge fan of that. Instead, I think that one should consider what happens with inflation as relates to equities and what does that mean for asset pricing in general and what something's worth. I think that's not given enough love. So, but the fixed income guys and the fundamental modeling guys, I know you look, I have a lot of respect for Ben Graham. I have a lot of respect for even, I'm obviously going to Omaha. So it's not like I don't have a lot of respect for the folks that do the financial modeling. I just think that the discount rate, it's important, but it's not the end all be all of how equities ought to trade, nor is it the end all be all of the real growth that these companies are driving in the marketplace and what that entails.
Cool. Thank you. Okay. One
You know what I
final
mean?
question.
Because here's the thing,
Right.
it does absolutely play into how you would think about revenues in the future. That's for sure, for real. But what it cannot truly correctly do if inflation is divorcing itself from interest rates is tell you what price they're going to get on the open market for some of this stuff, right? So, if you thought that interest rates are at two something, long-term rates at 2.5%. If you're trying to suggest to me that grocery stores are going to only raise prices on food by 2.5%, you'd be wrong, right? So I really have to understand better how exactly you're modeling all the parts, not just the discount rate, applied to those portions of what it is, and how you're thinking about people are going to be paid. Like I just think that right now using only that as a metric to think about your equity is a little dangerous because you just got some really weird moving parts in this marketplace.
Okay, yeah, I was
I think
thinking
longer
more
term,
of
though, they're probably right.
yeah,
I'm always afraid.
from an investment standpoint versus earnings, if that makes sense. But
Oh,
we
say it
should
again
look
to
at
me.
earnings. Well, okay, pass. Okay,
Oh
CEIX.
no! What is
Well,
it?
I just meant from an investor standpoint. How
From
does
an
it
investor
affect the multiple?
standpoint,
Yeah, how does it affect? Well, if the multiples are 20 or 18, for example, and interest rates are going up, does that multiple come down? So S&P multiple is 18,
man,
and if interest rates go up, okay.
it's a really, I mean, there are so many different ways to answer that question. I'd rather not answer. I feel bad because there are some people that would say that multiple should come down. Some people say that multiple should actually go up. And then some people say that should do nothing to the multiple. So for me, as a result, because my horizon is so short, I'm going to say it does nothing to the multiple. Someone with a longer term horizon might believe that that multiple technically should go up. And then some people with a very different way of thinking about it would be like, no, May, because I'm a fundamental person, I'm discounting my cash flows a certain way, that multiple should go down. So it really just depends on your point of view. And everybody's, opinions are like, you know what they say? Everybody's got one. Do you know what I'm saying? So I don't know another way to, it's really, really tough. I don't
So
know. And
there's
then there's
nothing
people
set.
that are just like,
There's nothing
well,
set
I'm
in
not
stone.
going to, what's that?
There's nothing set in stone.
Nothing said so. And then a lot of people are like, well, May, what is it that you want me to do? You want me to buy bonds at 2.5%? Is that what you want me to do? Like, you want me to lever bonds at 2.5% to get a rate of return that will make some sense for my children when inflation's at 7%? What is it that you'd like me to do? So there's those people too. So I have no idea how to think about, I think that it's a really tough time right now to think about asset allocation. The only place that you might want to consider is in the commodities complex, because, that one isn't come down to rates of return anywhere in particular. That one's as simple as supply and demand, and there's no supply and there's a lot of demand. You know what I mean? So that one's a little easier if someone was asking me and putting a gun to my head on asset allocation. The other stuff, I'm gonna sit there and probably cry if you put a gun to my head on that.
Okay, CEIX, the coal play. So liquefying coal into energy, is that easily done? Is it normally done? Is it just what the price of coal versus natural gas?
Oh my
Is
goodness. You know what? You're testing me on this. I don't know if it's necessarily easily done so much as it's not ideal. You know what I mean? The
okay,
real
so
issue that you have.
they'd rather use natural gas. Okay.
Yeah, I mean the whole thing with anything coal is going to be significantly more polluting because of the nature of that energy source. So
Right.
I'm really not looking forward to it. And on top of it, all of the coal companies have attempted to improve their ESG score via creating technologies or figuring out ways to do any number of things, but truth be known, there's no way that you can really make that a clean source of energy at this particular juncture in history. Maybe innovation will come up and figure something out. So nat gas is by far less pollutant. Now, provided you actually have very little slippage on that nat gas. Now, if you have nat gas that is, and you've got a lot more slippage because you're not very good at taking it out of the ground, then that's a problem. But here in the U.S., we tend to be a little better than the average bear at managing some of those things, which is why one solution that the environmentalists could have considered was just letting the U.S. Do its thing and help other countries transition off coal. That's not how it played out. And I know that there are people who are going to hate me like crazy on this video once it finally goes from just our subscribers to the YouTube, but that is what could have been done in the intermediate term and short term to allow a more peaceful way of transition. That's not what has transpired. And if we were confused, that's not what has transpired. We can just look at how steep the backwardation was in January when we were talking about it. And the subsequent impact of that steepness and backwardation to any desire for the companies to do CapEx.
Got it. Thank you.
Yeah. I really hate this situation that we're in because as much as I think right now you've got a lot of people messing in the oil market thinking, hey, can we just corner it in some way and bring that price down? This thing is going to fluctuate, I think, like crazy because, the oil market, while very liquid, is not infinitely liquid. So if you had some crazy ability to be the marginal buyer or seller, you could do some crazy things to whipsaw this around. Now, I think it's really hard, even as I'm saying that, that it's still really, really hard to do that. Don't get me wrong. But if people were just like, oh, we're just going to sell oil, you know, crazier things have happened in the commodities market. In some of the other products, like nickel, it's liquid, but it's not so ridiculously liquid that a big player can come in there and just move it. You know what I mean? That's why for smaller metals, I stay out. And plus, I don't know the rules of the London, the LME. And right now, given how tight the supply is in some of those, I'm anticipating that nickel is just the first time we're going to see it. It's not that we're not going to see stuff like that. If my mentors that taught me this stuff were correct, I personally have not yet really meaningfully lived through that, except, 2008 had a little bit of that, but not in this kind of way. I think what we'll see here by taking out such a large supplier will be a learning lesson for a lot of us who are, we're still getting gray hair versus we have gray hair, so to speak. Yeah.
Do you mean a large supplier of nickel? Is that what you're talking about?
A large supply of all raw materials, but Russia definitely what output produces. They're not the biggest reserve, but they are a big producer of nickel. Here, let me show you. I might have gone over this way too fast the other day, but and in fairness, I think most of this is being blamed on the fact that someone was shorting it, and that was a Chinese guy who basically owned a steel company stainless steel company, because he probably was long the physicals, quite frankly, and was happy to sell it there. But
yeah, he was hedging.
Yeah, he was hedging. It didn't work out for him because somebody decided to corner that market, and the reason has to do with. Let me just show you. Let's see, I got it here somewhere. Do I really not have it? I swear, I thought I went over this just literally the other day. The producers of nickel versus.
Yeah, that's cool. I mean, I remember it.
Yeah.
I just think that he had a huge short position and they squeezed him. I don't know what
They
he
squeezed
did,
him.
but
Fair and square. They squeezed him.
didn't his physical price go up?
Well, nickel, I mean, the LME is a physical delivery market, if that's what you're asking me.
Well, no, but if you're shorting as a hedge against your
Yeah.
physical product, I mean, the physical price should go up also.
Yeah. Yes.
If you're delivering it, right?
If you deliver, yeah, if you decide to deliver it outright, some portion, I'm sure you could deliver outright, some portion, but because they don't have the circuit breakers like we do, the orderliness of that is not going to be orderly.
Mm-hmm.
And also because, this is still also a levered market. So, even if you've got the physicals on the other side, you're still going to have to manage whatever leverage they're requiring associated with the change in value. Market leverage is such a weird thing. I feel like that's something you know better than I do, so I'm not worried about going too far into it. Do you know what I mean?
Well,
But
I don't know what the outcome was. Did he cover? Did he have to? Could he not make margin calls?
I think they've halted the market, and I think that the LME is still trying to discuss different formats of physical delivery or what have you. I don't know is the answer to that question. I have a couple guesses at what you might do in that circumstance when you actually do have someone that might be able to produce the physical on the other side, and all that stuff has to be cleared through the LME. I don't know how to think about it, to be fair, because this type of activity is rare. You know what I mean? I haven't, but sorry. What I was trying to show with this slide was just that on world production, this is a little stale. So some people are saying it's closer to 15%, something like that. But this is stale from 2020 from a website that I pull metals data off of sometimes. And then there are a couple little periodicals that'll publish different things. But you can see Brazil. We were talking about Brazil at the time, which I still think is a wonderful thing to have a little bit of exposure to as all of this plays out. But Russia being such a large producer, even if they aren't the largest in total reserve tonnage, so this is nickel in the ground not yet being produced. These are proven reserves, right? But Russia taking 11% out of the world market when there's already such tight supply is what initially drove the price upwards, I would say. And then, there's always players that are cornering markets that just know how to attack when the blood is in the water, so to speak. So who knows what took it up that last piece, but from
Well,
here
they
to
pick up,
here.
what they do is, I know this. They pick up a huge short position. They didn't know
Yeah.
who it was, just a large short position. So they squeezed that.
Yeah.
That's pretty normal, but
Yeah.
it's not bad for him as long as the spot price goes up with it.
Yeah.
All he
That's
was doing
true.
was hedging.
Hopefully that's all he was doing.
Well, he owns a company
100,000
that produces.
tons. Yeah, I
Right.
know, I know, I know, I know. That's why I think it's a little bit. So I agree with you. First of all, everything you're saying is true. I have no idea how it all play out. And then, but yeah. I mean, I'm hoping that all 100,000 tons that he was short, he can produce physically in the marketplace. And it's a pain in the ass. And hopefully he ends up with something that's really like, that nets him out in a good spot relative to what he brought it out of the ground for. But we shall see. We don't know, I think, the end of that story yet. But it sounds, yeah, you got me. Anyways, this
Sounds
portion
like
that would have made it fun
he
for them
sounds
to, because
legit.
I think, what's that?
He sounds legit.
He does sound legit. I'm just saying that from here to here, he probably, I mean, look, I'm not sitting on that exchange, so I don't know, but let's say he shorted it at this, let's say he got his trade off at this price at $40
Mhm.
or whatever.
Mhm.
Maybe he got it off a little bit lower, and he was looking at, maybe he held this contract way early because, I mean, if he's a producer, right? Um,
Mhm.
he's a stainless steel guy, so I don't know if he's like how exactly the nickel component, um, I'm not sure what access he has to the nickel component, if he already bought it and was just hedging it that way, or whether he was hedging his future price or what was going on,
Mhm.
or if he was hedging inventory, what was he doing? But if he decided in February to go ahead and sell it at 35 because it was trading at 30, then I think this conflict in Russia is probably what drove him well over his short, and then his attempt to cover his short is probably what spiked this thing aggressively. If I were to guess, okay, but that is just pure conjecture on my part. Not sitting in that market, it's always hard.
He produces stainless steel. Does he use nickel to produce?
Yeah, nickel is used in the production of stainless steel, so it could have been that he had it in inventory.
Oh, I see. Okay.
Or
Yeah, I would think,
alternatively, it
yeah,
could be these
he would
Chinese
be a
businesses.
buyer.
It could be a number of things, and to me, I'd have to do a lot more research, because the one thing with Chinese companies is a lot of them have these subsidiaries, and unless that's why I have a lot of respect for each market. Has got its own deal. Each stock has its own deal, so I would absolutely be talking over my skis. I have no idea the degree to which this man might be able to hedge this in the physicals market. Um, it's all of that would be worth checking out if someone is very focused on nickel and trying to understand this dynamic, but all of it's beyond what I got.
Cool.
Yeah, but it's totally known that the Chinese companies, and that's what makes China a very, like, um, because of this face, people are always like, May, what do you think about Chinese markets, right? And I'm always like, look, some of them I can tell you, and some of them, because the corporate structures are a little bit different than in the United States, right? In the United States, you read the 10K, all the corporate structures are there, and then there's even hyperlinks to click through to the other companies if you needed to, right? In the Chinese, first of all that's in Chinese, and I'm not a native reader of Chinese. You know what I mean? I'm really barely a native. I'm not a native speaker either. Like all that stuff was learned in college, and not very well, if I was going to be very honest with the world. But so you really have to kind of know all the little arms that company is in. Alibaba, even alone, I'm always a little scared because it has so many subsidiaries, and if you are not competent on those subsidiaries, you will absolutely be wrong from time to time, very wrong. Same thing. Some people, we had companies like that in the past in America, GE being one of them. But now, because GE is really a turnaround story, they talk about every single one of their little subs and what's going on in a way that's a lot clearer for the average analyst to get some kind of sense for it, or the average retail investor. But that structured, Asia loves that structure, and it's very difficult. That's a very specific expertise for sure. Any other
Okay,
questions?
that's it. That's it from me.
All right, cool. Good
Thank
luck
you.
tomorrow,
Thank
guys.
you.
Remember, with options expiration, be very careful with your positioning. I think it is, generally speaking, still risk off. This 25 basis points was reassuring in some ways and might create a little stability, but I think there's just way too much going on in the world to take big directional bets. Have your shopping list always at your side and just try to take shopping list bets when it gets even below the price that you might have thought it could go to. And with that, we'll close it out for today. Bye, guys.